Okay, uh, we are going to look at another topic under the risk assessment, which is use of analytical procedures during the risk assessment. Right? I told that we are going to discuss about the analytical procedures separately. So here we are focusing how we can use these analytical procedures at the stage of risk assessment. Right? At risk assessment process, how we can use the analytical procedures. This analytical procedure is very famous topic in your syllabus, and analytical procedure question also have tested at the examination. Right? So we'll look at what is analytical procedures in briefly, and there's another topic that we going to discuss later more about the analytical procedures, but here we are focusing how these analytical procedures will be using at the time of risk assessment. Right? So you can see in the tutorial, analytical procedures consist of evaluation of the financial information of plausible relationships among both financial and non-financial data. So what we do in an analytical procedures, we check the relationship between the financial data and the non-financial data. Say for an example, when your payroll expense has increased or your salary expense has increased compared to the previous year, you can check whether the number of employees of your organization has also been increased. Right? Technically. Right? There may be some other reasons also such increment. Maybe salary increment has been given, but other than that, if the number of employees has gone up, then you can consider that as a reasonable evidence for increment in the salary expense. Likewise, you compare financial data with the non-financial data. Right? So when we are discussing about these analytical procedures, these analytical procedures are help us to do investigation, right? Especially to identify the fluctuations and the relationships, right? Inconsistencies among the figures. These analytical procedures are very helpful. Right? So as we discussed in the previous section, these analytical procedures can also use in this risk assessment process, which is also we discussed under this SLAS 315 as well. Right? So when we discussed about these analytical procedures, there may be different kind of analytical procedures that we can do. Right? So we can compare, basically we can consider these analytical procedures to compare the figures. Like you can compare this year figures with the previous year information, this year information with the previous year information, like profit, what happened last year profit and this year profit, what happened to the expenses when you compare in the last year expenses and this year expenses. Likewise, you can compare the similar information from prior periods to the current periods. Right? Or else you can check the anticipated results, like example like budget forecast. Right? You can check your organization, this year profit is say 10 million. Right? You can double check or you can cross check this with your budget figures, whether the client has achieved as what they budgeted at the beginning of the year or their forecasts. Right? And prediction prepared by the auditors. Sometimes auditors are prepared in the prediction, right? Depending on the pattern of their income and expenses movement, we are expecting, right? We are anticipating this when we say for an example, when we analyze their five years revenue, we anticipated this year revenue should be increased by 5%. Likewise, we compare the facts and we check what is the actual result in the client. Now say for an example, when we analyze the last 5 year revenue figures, averagely the revenue has increased by 10%. So we are expecting this year also the profit will be increasing by 10%. So if client revenue has increased by 20%, so there is a questionable area, because when you check the average revenue over last 5 years, it has increased by 10% average, but this time it has gone all of a sudden at a 20% rate up. So that is a questionable area, or the questionable thing where you want to focus more, right, at the audit. Likewise, the auditors are also predicting, right, or else the industry information. You can check with the industry information. Now say for an example, assume you do an audit in a hotel. When you do the audit in the hotel, you know these guest arrivals, right? You can check the guest arrivals into the street. Now say for an example, your hotel is more focused about the European the guests, right? Your company's located in a place, and your company's or your hotel's infrastructures or your hotel's interiors, every the aspects of your hotel, right, has structured in a way to attract European guests, or the European the foreigners who comes to the country, right? So you can check the tourism board data during the year, how many total guests arrived to Sri Lanka, and out of that how many European the teams came into Sri Lanka, whether there's an increment in that or a decrease, right? Accordingly you can compare the audit or the audit client that you're going to audit, right? His hotel also mainly focus on the foreign crowd, the European foreign crowd, right? You can compare whether when the industry, or when you get the tourism board data, it says that total European tourist arrivals to the Sri Lanka. So you can compare that figure with your client's figures. Likewise, you can compare that sort of analytical procedures with the industry information as well, right? So that is exactly what we're doing is we do the comparisons, right? Basically what we do is we do the comparisons, or else you can do this kind of analytical procedures between elements in the financial information that are expected to confirm, to predict a pattern based on the entity's experience, right? You can see the relationship between the profit or the sales and the gross profit. When the sales increase, the cost of sales is also increasing, right? You're keeping a constant gross profit rate, right? When your profit increases, when your expenses is decreasing, you're expecting an increment in the profit, right? Likewise, based on the elements. Now say in other terms, like when you look at your balance sheet, your number of fixed asset or the property, plant and equipment figure has gone up, right? Same time, you know, the depreciation expense also should be increased, right? Likewise, you are checking the figures which is inbuilt in the financial statements. So elements in the financial statements you can compare, right? That is another thing, right? Or else those between financial information and relevant non-financial information. You can compare the financial information with relevant non-financial information, like we discussed, right? Salary expense or the payroll expenses, compare with the number of employees. Likewise, you can do sort of analytical procedures in different way. Just keep in mind, either these methods, what we're doing is we analyze the financial statement based on some patterns, right? Maybe you compare the figures with the previous year, or maybe you compare your own financial statement figures, or else you compare those with the non-financial figures. Likewise, you do some sort of a analytical or analyze and try to get an understanding, because this is essential part under the risk management process, right? So there may be different kind of analytics, maybe very complex one. You may have done some like we call them sensitivity analysis. You can do some sort of like scenario analysis. Likewise, very complicated analysis you can do, but very commonly used analysis is the ratio analysis, right? Ratio analysis under your financial reporting subject also you have learned the ratio analysis. So rather than looking for very complicated comparisons, you can do basically a ratio analysis and get an idea whether the variances when you're comparing with the previous year or when you're comparing with your industry data, whether your company the audit client's financial statement shows any unusual patterns or shows any the movement deviations which are not acceptable, right? So those kind of things can be easily traced through a ratio analysis, right? Because ratio analysis is very useful technique to do analytical procedures, right? So whatever the method that used by the auditor is based on his professional judgment, right? Maybe for some clients ratio analysis will be applicable, but for some clients the ratio analysis may not be applicable as it is. So in that case, the professional judgment, the auditor have to use his judgment to determine which method I should apply for this client to do an analysis or analytical procedures, right? Sometimes auditor can use, right, specific industry information, or else he can use some general knowledge of the current industry conditions, right, when he determining this ratio analysis. Now say for an example, basic the common things that we know at like when it comes to the current ratio, what is the benchmark that we should maintain, or when it comes to the quick asset ratio, what are the benchmark that we use. Those kind of things also can be used as tools when doing this analytical procedures, right? Okay, so in your syllabus basically this analytical procedures is mainly focused on the ratio analysis. So we'll look at this example, how to identify some risks areas depending on the ratio calculations, answers that we derive from the ratio calculation, right? Okay, you can read this the question. You're auditing the financial statement of PQR Limited for the year ended 31st March 2019. PQR Limited is a chain of bakery operation in 5 locations. The bakeries sell a range of cakes, pastries, bread, sandwiches, pasties and drinks which customers purchase in cash. The company had a challenging year. See, the company had a challenging year according to the directors. See, the directors tells about the governance of the organization, right? Governance, corporate, those charged with the governance, the people, those who run the organization, govern the organization, tells that it's a challenging year, right? And it's renegotiations and is renegotiating its bank overdraft facility with its bank. The statement of profit or loss for the year ended 31st March 2018 shown below together with the draft statement of profit or loss for the year ended 31st March 2019. So you have the audited figures for 2018 and 2019 draft financial statement figures, right? You have the revenue figure and the cost of sales figure, gross profit, administrative expenses, selling and distribution and interest payables would have been the finance cost, and you have the profit before tax figures, right? When you check the last year profit, it's 902,000, but this year it's 1.6 million. So it looks like it's a huge increment. And when you compare with the director statement say it's a challenging year, but see how their profit has gone up, right? Okay, we'll do a small ratio analysis. The requirement is, as part of your risk assessment procedures for the audit of the PQR, perform analytical procedures on the draft statement of profit or loss, identify possible risks areas. See, you want to identify what are the risks areas requiring for further audit works. That's what we at the examination also it's expecting from you. By giving a particular P&L and a balance sheet, they're expecting to identify risks areas. You want to give why you pick this as a risks area, right? So this is very simple example. I'll put those into the Excel sheet. See, I have put those into an Excel sheet, and I have taken the variances. Very simple ratio analysis I have done. What I have done is I have checked the previous figure with the this year figures. We have done a comparison, right? And I have taken how much, what is the increment, right? When comparing with the previous year, what is the increment of decrease, right? So you can see the revenue has increased by 12%, right? I got the difference of these two, right? 4,205 minus last year figure. So this is the difference. This difference divided by the last year figure, right? So that's how I arrive this 12% growth, right? So likewise that apply for all. So the revenue has increased by 12%, cost of sales has decreased by 12%, right? The gross profit has increased by 28%, administrative expenses has decreased by 16%, selling distribution decreased by 8%, the interest payable the interest expense has increased by 2%. So you can see the profit for the year has increased by 87%. And we calculate here the gross profit ratio. The gross profit ratio you can see 59% and 67%. Net profit ratio is 24% and 40%, which is this increment of this 87% compare with this last year, right? So when you look at this the question, when you look at this scenario, right, you can identify there are like unusual patterns, right, in the financial statements, right? Basically simply මොනවද වලට මේකින් identify කරගන්න පුළුවන් unusual patterns විදිහට තියෙන්නේ. Look at this. Their revenue has increased by 12%, right? But the profit has increased by 87%, right? Profit has increased by 87%, but revenue has increased only 12%. You can see the director saying that this company is facing a challenging situation. So in a challenging situation, can you expect a profit increment of 87%? That is a questionable area. So you have to consider this, right? So under the risk assessment process, the risk assessment process එකේදී identify කරගන්නවා revenue එක වැඩි වෙලා තියෙන්නේ 12%. හැබැයි profit එක වැඩි වෙලා තියෙනවා 87% වලින්. Unusual වගේ. Sometimes the revenue may be incorrect. සමහරවිට cut off එක හරියට කරලා නැතුව ඇති. එන අවුරුද්දේ revenues මේ අවුරුද්දට දාලා ඇති නැත්නම් මේ අවුරුද්දට එන්න ඕනේ revenue මේ අවුරුද්දට අරගෙන නැති වෙන්න පුළුවන්, right? Cut off errors can be occur, right? And look at this. Revenue has increased, but cost of sales has decreased. Can it possibly happen? Can't, no? If the revenue has increased 12%, the cost of sales also somewhere close to 12%, 11%, 12% increment should be there. That is called the matching convention. When your revenue increases, cost also increases. Maybe sometime you're closing inventory wrong, your cost of sales wrong, right? Maybe sometime you're closing inventory wrong. There may be mistakes in the closing inventory. That may be the reason why it become minus figure where you want to focus on, right? And look at the administrative expenses. Under the operating expenses, you can see administrative expenses has decreased. When revenue increases, the administrative expenses is decreasing, highly unlikely. And especially look at the selling and distribution also. Your sales income has increased, but the expense that you incur for the selling and distribution is decreasing. It's little unlikely, right? So you have to focus on these areas. And also you can see the profit or loss for the year which we discussed. The interest payable seems to be there is no any much change compared to the previous year. So you can easily check this area by looking into the bank statement. You can easily get an idea about what are the costs that they have charged to the P&L, right? That is not a big issue, right? And we discussed about the profit also. There's an unusual pattern in the profit and gross profit ratio. You can see it is 59% in last time, this time 67%. Normally the gross profit ratio won't fluctuate over a period of when you compare with the previous years. It should be sort of a constant. It may be like 60% this time, but it can't be 67%. Something wrong with the cost of sales or something wrong with the revenue, right? Net profit also we identify as a critical area, or the area that you want to focus more. Likewise, you can do a ratio analysis and identify what are the unusual patterns. So in this example, which is not a complicated one, which is very simple one, from this simple example we could find like 4-5 matters or 4-5 areas where we need to focus on, right? Likewise, you can do a ratio analysis and you can identify what are the susceptible areas as an auditor you should concern of, right? You can see the answer is also given in the tutorial. You can see in total PQR profit for the year has increased by 87%, which appears to at odd with the revenue figure, which has only increased by 12%, right? In comparison to the previous year, this may indicate that revenue has been inflated or incorrect cutoff applied, right? Especially given the fact that the directors of PQR have described the year as a challenging, right? Because the directors also consider the year as challenging year, but still you have a huge profit reported during the period, right? Revenue has increased overall by 12%, but cost of sales have fallen by 12%. We would expect an increase in revenue to be matched by the corresponding increase in the cost of sales. Again, this may indicate incorrect allocation of revenue in order for the bank to look favorable on the company and increase its overdraft facility. Yes, they are willing to get a bank overdraft also, right? So maybe they manipulate the revenue. It could also indicate an error in the valuation of the closing inventory. Maybe sometimes the closing inventory is wrong where you want to focus. The gross profit has increased by 28%. See, in our calculation, the gross profit has increased by 28%, right? 28% compared to the previous year. The audit will need to focus on the change, which is significant, focusing on the revenue and the cost of sales figures to establish the reason for the increase. Technically, why there's a huge increment in the gross profit, right? That the questionable. Administrative expenses have fallen in comparison to the previous year, decreasing 16%, which is unusual given the revenue has increased by 12%. When your revenue is increasing by 12%, your expenses also likely to be increased, but rather than what happening, expenses has decreased by 16%, right? Maybe a reasonable reason, but still at the risk assessment process, risk assessment stage නේද අපි මේ risk assessment කරන වෙලාවේදී අපිට doubt එකක් එනවා. සමහරවිට මේක හරි වෙන්නත් පුළුවන්. But technically there should be wrong. ඒක තමයි අපි මේ risk assessment කරන point එක වෙලාවේදී මේ analytical procedures කරලා try කරගන්නේ. Right? We would expected an increase in the cost to be in line with the increase in the revenue figure. This could indicate that expenses may be understated through the incorrect cutoff or incorrect capitalizing expenditures, which should be written off to the statement of profit or loss for the year. සමහරවිට capitalize කරලා තියෙන්න පුළුවන් expenses P&L එකට charge කරන්නේ නැතුව. A similar issue applies to selling and distribution costs, which have fallen by 8%. They have not increased as expected in line with the revenue. Normally, when the revenue increases, your selling and distribution expenses, which is relating to your revenue, right, also should technically be increased. But what happened? It has gone down by 8%. There could be legitimate reason for the change, but this area need to be investigated further during the audit fieldwork stage, right? When you do the audit works, you want to look at this, why it has gone down. Interest payable has stayed in line with the previous year, increased only by 2%. This figure can be verified easily during the audit fieldwork by inspecting bank statement and other relevant documentation from the bank, right? It's easy, so nothing to be panic over the interest expense because it seems to be fairly presented in the financial statement. That can be verified by checking the bank statement, right? Likewise, you can identify what are the areas that you want to focus, right? At the examination even, you are getting some questions, but a little bit complicated than this. But basic technique, what you want to do is you want to do a ratio analysis and identify some key areas where you believe at the audit you want to focus on more because there are some issues with the ratios, relationships, right? අන්න ඒ වගේ දේවල් අපි අයිඩෙන්ටිෆයි කරගෙන ඒවා ફોකස් කරගන්න. ඒවා අයිඩෙන්ටිෆයි කරන එක තමයි ඔයාලගේ එක්සෑම් එකකින් අහන්නේ. ක්වෙස්චන් එකක් දීලා P&L එකක් බැලන්ස් ෂීට් එකක් දීලා ඔයාලගෙන් අහනවා කොයි විදිහටද මේකට රේෂියෝ ඇනලිසිස් එකක් කරලා මොනවාද රිස්ක්ස් තියෙන ඒරියාස් මේ ඔඩිට් එක කරද්දී ඔයා අයිඩෙන්ටිෆයි කරගන්න ඔයාගේ රේෂියෝ ඇනලිසිස් එකෙන් කියලා ඔයාලට පොයින්ට් අවුට් කරලා දෙන එක තමයි questions වලදී ඔයගලගේ exam එකේ බලාපොරොත්තු වෙන්නේ, right? Hope you got an idea basically about the analytical procedures. We're going to discuss about these analytical procedures little in detail in later chapters, but here what you want to keep in mind, at the risk assessment process you use these analytical procedures to identify susceptible areas where you want to focus when you do the audit. Hope you understand the basics of analytical procedures.